All right. In the prior recordings, we figured out sort of the fixed and variable costs. In this one, I want to talk to you about figuring out your after-tax operating cash flows. This is a lot, I realize, in terms of sort of pulling out different things related to taxes. Some of you may not have covered those, but it is a reality of this sort of modeling, and so you are going to have to learn a little something about business taxes for this project. So basically what we're going to start out with is thinking in terms of the kinds of taxes that we might be subject to for this business. We said we would buy property, so we'll have a property tax. We are going to have depreciation on the land and equipment that we use, so we're going to have to kind of figure out what those are. We'll have a state income tax in the form of both a business privilege tax and a corporate tax. And then we'll have a federal income tax. I've looked up some rates. You can certainly Google and find out for your state what those rates are, but this example's for Alabama, obviously. But the bottom line is there are those taxes. And at the end of the day, you can't really go anywhere until you start estimating your assets. And really the big ones that we're looking at here are your land and building and your equipment. That's not to say that there won't be some other tangible assets, but these are the ones we'll focus on. I know that a lot of times for accounting purposes, you'll also be modeling cash and accounts receivable and inventory and all those sorts of things. We'll get to cash, I promise. The accounts receivable and the inventory are part of accrual accounting type stuff that we don't pay attention to for these purposes. Sort of simplifies that part of it. And so it really does leave us with sort of a short list of assets here. And again, you'll have to think of what that is for your business, what makes sense, but generally it's a pretty short list. The land and building, I did a little bit of research, and I'm going to take an approach here that's really a budgeting approach, and basically say I believe that we can find acceptable land for $1 million or less. So I'm going to build in terms of land and building that. Now I have to do an allocation between those two because the building part of the purchase is depreciable, but the land part is not. And so I did just a little bit of looking. Usually falls somewhere between 20 and 40% of the value of a commercial property is land. The rest of it is building. I'm going to put it at 20. Actually, I'm going to put it at 40. Take that back. And the reason is that I want to be somewhat conservative in my depreciation here. I want to have a smaller depreciation rather than a higher depreciation. Because that's the only reason we're doing depreciation here. It's not a cash expense, but we need it to figure out our taxes. So if I assume a really big depreciation, then I'm going to make my taxes less, and that may overestimate how much money I'll actually have. But if I make my depreciation small, then it's going to make my taxes larger, and so that's going to be a conservative estimate of how much my actual money left over will be. All right, so we assumed 40, and this will just be 1 minus whatever we assumed up there. So again, keeping up with our mantra that we want to have as much of this be formula driven as possible, and not just stick numbers in wherever we feel like. And so since we know what we've assumed $1 million and that 40% of it is land, we can just do this. Same thing, we can do that again for this. There we go. So good news is that we now have that. Now with the property, with the land and the building comes a property tax. And the assessment rate on this, I went out and looked, and it's roughly about 7.5% of the assessed value. All right, and the assessed value is 20% of the market value for commercial property. So we will just put in 0.075 times 0.2, And so what we really have is a 1.5% property tax based on the value of the property. Okay, that property tax is applied to everything. So in our case, we're going to go ahead and just set this total land and building there equal to that. So the property taxes is equal to this amount, which we got to put a dollar sign in to lock in, times the combined value of those. And for our purposes, we're just going to assume that they stay the same all the time. Obviously, you don't have to, but we are. All right. So we will have a $15,000 property tax. Now, I've set that here. In reality, that one's not going to happen until out in month 12. So I'm going to drag it all the way out to month 12. All right. And then it's going to happen every year after that. So we just want to build that in. And you know, it is a cash expenditure, so we do care about that. I could have put it up in the property tax, but I mean in the periodic stuff, but it's not really periodic the way that other things are that only happen once a year, you know, that have monthly. This only happens once a year. So I just feel like this is an easier way to model it. So there that property tax is. And you also have to figure out depreciation. So depreciation's all kinds of fun. Sorry, I'm highlighting my little assumption here. If you haven't already done this, you're gonna be thrilled by this. So depreciation, first thing you have to know is how many years you can depreciate it over. Buildings usually 30 years. Restaurant equipment's 5 or 7 years. We're going to go with 7 here. Again, the idea basically being that if we keep the depreciation low, then we're going to have higher taxes. Okay. Now, a lot of times there's the opportunity for accelerated depreciation. We're just going to do something called straight line depreciation. All right. And how that works, let's just start out with, so it is equal to, because this is monthly stuff, we're going to take the building and we are going to we're going to divide it by this number of months or number of years, right? So that means you're basically taking 1/30 of it, okay? And then we're going to take, for now, that whole thing, we're going to divide it by 12 because we're only doing it on a monthly basis here. All right, so that becomes an amount per month that we can string out over here for 12 months. Now you could have just loaded it all into month. Sorry, what would help is if I had extended all this out. So equals that. All right, it doesn't have any values to work off. Is the problem. Okay, and you're going to see in a minute, I'm going to modify that formula just a little bit, but for now, just to get it started. So you know, we could have done that, or again, we could just take that amount and you know, stick it all into month 12, which is kind of where it would show up for tax purposes. But we're going to do this. The equipment we haven't settled on a value on. A common value in the restaurant industry based on research for cost of equipment as a percentage of sales is about 10%. So we can go back up and just say it's equal to, remember we had that amount up here that was the year 2 sales. We can do that amount times 10%. And so that says we're going to have a little over $200,000 worth of equipment. Kind of makes sense by the time you buy, you know, tables and chairs and all that kind of stuff. Okay, so we'll just drag that on out. All right, and this works for my business because I'm not really assuming a whole lot of growth in customers after the first year, and I'm sort of building the business out to be the size that it would be at full scale. I'm doing that at the beginning. If you've got a business where you're starting out, maybe on a small scale, and as you grow customers, you're going to need to add assets and stuff. You may not want to just base your needs on the values, the revenues for 1 year. You may want to think about how much assets that you're going to need in terms of that they will go up as your revenues and your number of customers go up. Again, in my case, my number of customers isn't actually going up year over year. It's just that my prices are going up, and that's what's driving this. And if you're not clear about that, that is once again something else that we can talk about in class. All right, so now that we got the equipment, we can kind of do a similar thing here. So let's see, C60. C60, so that's the amount of equipment there. Yeah, not exactly sure why I'm doing that in month 0, but that's okay. I'm going to take it off and just drag it over here, I think. Okay, we're going to change that so it's not month 0. Do the same thing with this. Okay, and so what's going on there, I don't want it to be a month 0 because really we're not going to start doing that. Although you could make the argument we are. Just for simplification, I'm going to move it over here. All right, so on this one, just checking. So it's referencing the $201,000 that we have there. It's referencing the 7 years. So it's a bigger number even though you've got less equipment, because it's basically got to all get depreciated out in 7 years. Okay, so I'm going to show you why that's relevant here in just a second. So we've got that built out kind of for the months. Now, what you want to do is you need to keep track of your cumulative depreciation. So your cumulative depreciation is equal to the sum of everything cumulatively. So for your building, I guess it would help if we did a little bit of this. Keep my head straight about what rows I'm working on. There we go. All right, so for the building, it equals the sum of, everything to date at any point in time. A little trick for how you do that. If you just lock in your formula the first column, then you're always calculating the sum of everything from the first column going forward. So when you start dragging this forward, you'll see what happens. Kind of get out to month 12, and lo and behold, it's calculating everything out, and it's adding up to the 20,000 total you would expect, right? So you can do the same thing. You just drop that down and do the same thing for the equipment. That's perfect. Okay, and here's the deal, right? As you depreciate the equipment, that value is going away. You want to make sure that once you've fully depreciated it, and so the value of the equipment minus or the asset minus the depreciation goes to 0, you want to make sure that you don't depreciate it any further. And so what you generally do is we'll change our formula just a little bit. Here's the calculation of the depreciation, and what we want to do is to say you take either the minimum of that, right, or whatever your building value is in this case, minus whatever your cumulative depreciation for the building is. And so the idea is that I'm not sure why that did that. Didn't like it. clearly didn't like that, but so idea would be that because you got to look at the one before, sorry. So it would really be the C values. So you would look at what it was, what had happened in the prior period. That's what I did wrong. So for column month 1, we would look at month 0 and say, by the end of that month, had we fully depreciated yet? And if we did, then we can't depreciate anymore. So that's what created the circular reference. So there we go. All right. And we'll do the same thing here. Min that, or the difference between equipment minus the amount equipment depreciated in the prior period. Okay. And again, that doesn't matter too much in the first year, but we just want to keep these nice clean formulas. Okay, so we get out here. That's all good. Now, we want to drag this over to year 2. Everything's pretty much going to work okay, except for we got to get rid of this minus, or this divided by 12 now, because we're now doing annual amounts instead of monthly amounts. Okay, so we get rid of that, and we drag this thing out. And what you're going to see, you can see that particularly on the equipment, the depreciation is starting to accumulate pretty good now. So by the time you get out to year 10, you will have fully depreciated basically at the end of year 7 all of that equipment. So you'll see that you don't have any more depreciation being charged in years 8, 9, and 10 on that equipment. All right. So again, depreciation, lovely concept for tax purposes, a real sort of wrinkle, if you will, for us. So there you go. But we do, as a result of that, we can get a total depreciation amount now, and we'll get that, and it's just the sum of these, so equals sum of the individual depreciations. And again, we did none in that period. All good for us, and you drag it all out. It's not the sum of the cumulatives, right? That's easy mistake that people make. It's the sum of the periodic depreciations. Looks like I need to hide some decimals here. Let's see if I can do that. No, it doesn't like that. A lot of times it won't let you do that if there's different formatting for some of the cells and others, like non-numeric formatting. So it doesn't like that at all. So make them all the same and then hide the decimals. But key here is, it is carrying over the proper amounts of depreciation for each year. You got the cumulatives down here, but for your purposes of taxes, what you need is the per each year. So now we have that. We can go in and fill out the depreciations. So we can just make it equal to whatever the totals are. Up here. Drag that out. Okay. So one of those is a real cash expense, one is not. But yet both of them get deducted for state cash flow purposes, right? And so when we go to figure out our state income tax cash flows, I'm going to just highlight that as a little kind of light gray thing for us to pay attention to, right? What we're doing is we're going to take what our actual cash flows are, and we're going to subtract from that property taxes and depreciation, and that becomes the amount of value, if you will, that we have that we have to pay state property tax on. All right, so we're going to pay, state income tax on. So we're going to pay this amount times this amount. Right, so let's see, we're going to put a dollar sign in front of the row of the cash flow amount. We're going to put a dollar sign in front of the column of the percentages. That way we can drag this down. Okay, and you can see this is sort of an interesting thing. When you have a loss in a period, you can actually take that money as a tax credit. And so by taking it as a tax credit on a periodic basis, that's simply recognizing that when you roll all of that together over time, that will offset some income that you make later on, and you won't have to pay the taxes on that income. So works out pretty well for us, actually, in terms of this. So that leaves us with a federal income tax amount. And that federal income tax amount is actually equal to the before tax amount minus property taxes, because property taxes get deducted. Well, I guess for tax purposes, we'll just say it is this amount. So it's equal to the after tax, the state income tax amount minus the state income tax. Basically, the feds don't require you to pay taxes on the money that you're paying as state income taxes. They let you deduct that off right now, so as a corporation. So that helps. And I'm just going to show you this because I always think that it's kind of interesting how it works out, and a lot of times people don't understand what happened. I don't like that formatting. Let me change back. But you start out with an after-tax, with a state income tax cash flow of minus $159,000 in the month 0. It went down to minus $148,000 after the state taxes. And the reason is because of that tax credit. Getting the tax credit is like avoiding paying future taxes. So it actually improves your cash flow situation. All of this complexity with taxes is one of the reasons why you have to model this, because they can make a big difference in terms of how things work out. So for federal taxes, we would then take this state income tax flow and simply multiply it by the federal taxes. And I'm going to say this, the federal tax system is a bit more complex than this. We're making a simplifying assumption of what we would call an effective tax rate of 25%. In fact, the corporate tax rate, federal corporate tax rate, starts out at 15%, goes up right now at almost 40%, based on what the total amount that you have. But on an effective basis, usually we assume somewhere around 25 to 30%. This is not a business that's making enough money, I think, to hit the 30% bracket. So there we go. And again, because you lost money, the federal tax is actually very favorable to you. It's giving you another tax credit, if you will. All right. And so now we are in a position to calculate our after tax operating cash flows. All right, I'm going to just format that the same as over here. Probably could drag that up one, but you need to pay attention here because we got one little thing that we've got to consider here. So it is equal to the before tax cash flows minus the after tax cash flows, and then minus depreciation. And the reason it's minus depreciation here is that the depreciation isn't real cash. So we have to take it out. And you just take that formula and you drag it across. And that gets you to the cash flows that we're looking for pretty much for our business. So again, you've got this one big after-tax operating cash flow at the beginning, $111,000, and then you've got some others after that that are positive. I mean, here you're still negative because of the taxes. Let's look at that. You were 362. You had a credit here. and credit, credit, credit. All right, 148 minus that, 348, 3.4 minus that. Something's not right here. Oh, because you have to add back in the depreciation. That's what's wrong. I need to add back the depreciation. My bad, sorry. I did it wrong. So I'm going to use my little command shift control right to fill it all right. There we go. Sorry about that. That was a little bit frustrating, but so what I had done by mistake was I had subtracted off the depreciation when in fact the whole point of it being us making an adjustment for it is that it's not real cash. It had already been deducted out of these amounts. It needed to actually be added back in order to get to real cash. And so again, here you've got your negative cash flow offset by your tax credit. You got some positive amounts here. By month 5, you're going negative again, partly because we're going into, I guess, the winter break. But you start to go positive again for a little while. Now, month 11 dips down just a little bit. Month 12 goes negative. Part of the reason month 12 is going negative is that's when we're recognizing the property tax. So that kind of hurts you a little bit in terms of that you got to pay that in a month that's not actually a busy month. In reality, you may pay those property taxes in a better month for you, but you know, we're just doing this for simplicity's sake. It is really just getting the year-to-year cash flows that's probably the most important, and those look to be good. And so at the end of the day, little thing just trying to get from before tax to after tax winds up being probably the most complicated thing about this whole process. But we made it, so thank you guys for that. Again, everybody's going to have questions. I'm sure if you have questions related to going from before tax to after tax, bring them to class. Happy to work through them.